The data suggests that we may be in a period that resembles the early stages of the 1990s internet build-out, when early positioning around a major technological shift helped drive a dramatic rise in household wealth. Between 1990 and 2000, U.S. household net worth increased by roughly $22 trillion, and many of the biggest gains were tied to the growth of the digital economy. History shows that most people only recognize these shifts after the largest gains have already happened, but the 2026 data still points to a meaningful window for ordinary individuals to learn, adapt, and position themselves early in the AI era before the technology becomes fully normalized. Here is the logical, data-driven breakdown of how this shift is creating a new class of opportunity and how people can think about positioning themselves today. We are moving through 2026 in the middle of a major realignment of capital, labor, and technology. While headlines focus on daily volatility, the underlying data tells a deeper story about how new wealth is often created during periods of infrastructure build-out and rapid adoption. History is a relentless teacher, but its most valuable lessons are often forgotten by the time they become relevant again. If you stay with me through this entire breakdown, I am going to unpack the mechanics of this shift piece by piece and show why the path to building substantial net worth today may share some important similarities with the path taken by those who recognized the digital future decades ago. The fundamental problem for most retail investors is delayed recognition. People often identify a major opportunity only after the largest gains have already been made, which leads to the same cycle of regret. They hesitate because of skepticism, confusion, or inaction until the window of outsized advantage has narrowed. Think back to the early 1990s. In 1993, most people had no idea what a website was or why the internet would matter. Yet the acceleration that followed was extraordinary. By 1999, Amazon had grown from a young startup into a multi-billion-dollar company. During roughly the same era, Microsoft created thousands of employee millionaires through stock compensation and long-term growth. Investors who understood the importance of the infrastructure behind the digital age, including companies such as Dell, Cisco, and Intel, saw enormous returns over time. The scale of the wealth expansion is visible in Federal Reserve data, which shows that U.S. household net worth rose by roughly $22 trillion between 1990 and 2000. That does not mean every household benefited equally, and it does not prove that ordinary people alone drove the entire increase. But it does show that major technological transitions can coincide with massive asset appreciation across the economy. At the same time, a darker pattern emerged. Many people ignored the rise, only entered after the excitement peaked, and then suffered heavy losses when the dot-com bubble collapsed. A similar pattern appeared in the early social media era. When Facebook launched in 2004, many people dismissed it as a niche product for students. By the time of its 2012 IPO, the company was valued at about $104 billion. Early employees, founders, and investors saw life-changing gains, while much of the public only understood the scale of the opportunity much later. Now the calendar reads 2026, and we are watching a technological transition that many analysts believe could be as important as the early internet era, even if the comparison is not exact. Some people describe this moment as part of a new industrial phase shaped by artificial intelligence, automation, and digital infrastructure. However you label it, the core point is the same: AI is beginning to reshape how people work, how businesses operate, and where capital is being deployed. This is one of those moments when an ordinary person may have a chance to get ahead of the curve, provided they avoid becoming a passive observer while the economic landscape is changing in real time. This shift is bigger than software alone. It involves the convergence of AI, automation, and the infrastructure required to support both. That infrastructure includes high-performance semiconductor chips, data centers, robotics, cloud computing, and cybersecurity systems. You can think of this as the physical and digital skeleton of the next phase of the economy. Without it, the promise of AI cannot scale. The economic implications are significant. McKinsey estimates that generative AI could add between $2.6 trillion and $4.4 trillion in annual economic value when applied across industries. In addition, broader automation and related technologies may contribute even more to long-term productivity growth. This is not just a benefit for a few large technology companies. It has implications for healthcare, finance, manufacturing, real estate, retail, and many other sectors. What matters most is the speed of adoption. Technological change is no longer unfolding over long, comfortable cycles. It is moving much faster than previous waves. In the past, consumer platforms took years to reach their first million users. More recently, tools such as ChatGPT reached 1 million users within days. That speed matters because the window for early movers may be shorter than it was in earlier eras. In the 1990s, people had years to recognize what the internet was becoming. In AI, that window may be much tighter. The adoption data also points to a deadline of sorts. The World Economic Forum has reported that roughly 75% of companies surveyed expect to adopt AI by 2027. That does not mean every company is already deeply integrated, nor does it mean the opportunity disappears overnight. But it does suggest that the period before widespread normalization may be limited. By 2030, AI will likely be embedded far more deeply into the workforce and business operations than it is today. That means the advantage of being early may diminish over time, even though opportunities will still exist later. To make this practical, it helps to think about the opportunity in 3 layers. The first layer is infrastructure. In major technological buildouts, the companies that supply the essential tools often benefit regardless of which end products eventually dominate. In the 1990s, the firms building routers, servers, and networking equipment became critical to the internet economy. During the gold rush, the people selling shovels often did better than the miners themselves. In the AI era, that infrastructure consists primarily of semiconductors, data centers, cloud computing, and cybersecurity. Start with semiconductors. These are the chips that power AI models, cloud systems, and modern devices. Global semiconductor sales totaled roughly $526.8 billion in 2023, and the market rebounded sharply in 2024, underscoring the scale and momentum of demand. Chipmakers are central to the AI economy because no model runs without compute. Next are data centers. Every AI query, every model training run, every generated image, and every enterprise workflow needs physical computing capacity somewhere. Demand for that capacity is rising quickly, which points to a very large build-out not just in software, but in land, power, cooling, and connectivity. Then there is cloud computing. As AI usage grows, demand for cloud services tends to rise with it. The cloud is what connects users, businesses, and applications to the computing infrastructure behind the scenes. The more AI becomes embedded into ordinary workflows, the more important cloud systems become. And finally, cybersecurity. As more sensitive data, business processes, and government systems are tied to AI-enabled infrastructure, the need to protect those systems expands alongside them. That makes digital defense an essential part of the broader infrastructure story. The second layer is business application. Every major technological shift creates new businesses, destroys others, and forces many existing firms to adapt. The internet era helped end companies like Blockbuster while enabling businesses like Netflix. The same basic pattern is unfolding again. AI is changing cost structures, workflows, and competitive advantages. A company that can use AI tools to handle a large portion of repetitive customer service, document processing, scheduling, or internal analysis may have a meaningful cost advantage over a company that does not. That creates opportunity in 2 directions. For business owners, AI can improve efficiency, reduce costs, and expand output. For consultants, freelancers, agencies, and operators, there is a growing market for helping businesses understand and implement the tools that already exist. Many firms are still at the early stage of adoption, and they are often willing to pay for guidance simply because the knowledge gap remains wide. The third layer is career and income. This is the part that may matter most to people who are not investors and are not trying to launch a company. In the near term, AI is unlikely to replace every worker. But workers who understand how to use AI effectively may outperform those who do not. Studies have shown that, in the right context, AI assistants can reduce the time required for certain tasks while also improving output quality. That does not mean every job becomes dramatically more productive overnight, but it does show how quickly these tools can create an advantage. Over time, that kind of efficiency can affect promotions, pay, and job security. History also contains examples of ordinary individuals who built great wealth not by inventing the future themselves, but by recognizing where growth was heading and staying positioned for a long time. And Schreiber is one example often cited in financial circles. She was a former IRS auditor who turned a relatively modest sum into a multi-million-dollar portfolio over decades through disciplined long-term investing. Her story should not be used as proof of easy riches or guaranteed outcomes. But it does illustrate how powerful long-term positioning can be when it aligns with durable economic growth. At the same time, none of this should be confused with certainty. Investing always involves risk. Markets correct. Companies fail. Narratives break. Anyone promising guaranteed millionaire outcomes is not being honest. What history does show is that every generation tends to encounter a small number of major shifts that change the economic landscape. The people who understand those shifts earlier often benefit more than those who wait until the opportunity is obvious to everyone. Based on what we can measure today, including adoption rates, infrastructure spending, enterprise interest, and labor market signals, AI appears to be in an early and rapidly developing phase. It may not be identical to the Internet in 1994 or 1995, but the comparison is useful in one important respect: we may still be earlier than most people realize. Governments and corporations are both increasing their attention and spending in this area, and whenever public support aligns with private investment in an emerging sector, it tends to increase the level of economic activity and competition within that space. If you are an investor, one way to think about this is to focus not only on headline AI names, but on the infrastructure that supports the broader ecosystem, such as semiconductors, data centers, cloud computing, and cybersecurity. Those areas can benefit from overall sector expansion regardless of which application company ends up leading the market. As always, diversification matters, due diligence matters, and you should never risk money you cannot afford to lose. If you are entrepreneurial, one of the clearest opportunities may be the gap between what AI tools can already do and what the average business owner still does not know how to implement. You do not necessarily need to be a developer or data scientist to create value. You may simply need to know more than the client and be able to solve a real operational problem. And if you are employed and focused mainly on income stability, then learning to use these tools well may be one of the best forms of career insurance available today. In many workplaces, the most valuable person in the room will increasingly be the one who can combine judgment, communication, and AI-assisted execution better than everyone else. What matters now is not hype, but positioning. Major technological shifts tend to reward the people who understand them early, build useful skills early, and act before the opportunity becomes obvious to everyone else. AI may not unfold exactly like the Internet did, but the pattern is familiar: new infrastructure, rapid adoption, and a temporary advantage for those who move before the crowd. Whether the path is investing, building a business, or becoming more valuable in your career, the key is to understand the shift before it becomes old news. I am not a financial advisor. This presentation is for educational purposes only, and any outcome depends on your own decisions, research, execution, and risk tolerance.